Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Mcgraw Hill Inc. quarterly report. Mcgraw Hill Inc. offers a diverse range of businesses and services across various markets. In the K-12 segment, the company provides core, supplemental, and intervention curricula to support schools' needs through blended digital and print learning solutions. For higher education, Mcgraw Hill offers adaptive digital learning solutions, content, and instructional materials for students, instructors, and institutions. The global professional segment caters to medical and engineering learners with comprehensive digital and print solutions accessible through various mediums. Internationally, the company serves approximately 100 countries and 80 languages outside of the United States through its distribution network, offering K-12 and higher education solutions. Unfortunately, I don't have access to the extracted summary. However, I can provide a general overview essay on what might cause a stock price to drop. The stock price of any publicly traded company, including Mcgraw Hill Inc., can fluctuate due to various market and economic factors. One possible reason for a decline in stock price is poor financial performance, such as decreased revenue or profits. This can be caused by a range of issues, including increased competition, changes in consumer behavior, or failure to adapt to new technologies. Another factor that can impact a company's stock price is industry trends and outlook. If the industry is experiencing a downturn or facing significant challenges, investors may become cautious and sell their shares, leading to a decline in stock price. Additionally, external factors such as economic recessions, interest rate changes, or global events can also affect a company's stock performance. In some cases, a company's stock price may drop due to internal issues, such as leadership changes, restructuring efforts, or scandals that damage the company's reputation. These types of events can erode investor confidence and lead to a decline in stock price. It is worth noting that every company is unique, and the specific reasons for a decline in stock price will depend on the individual circumstances. However, by understanding these general factors, investors and analysts can better assess the potential risks and opportunities associated with a particular stock. Mcgraw Hill Inc. maintains a market capitalization of $3 billion, broadly in line with the industry peer group. Mcgraw Hill Inc. trades at a higher price-to-book ratio of 8.7 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 95% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes, such as buybacks or dividends, rather than operational deterioration. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth for a company can be attributed to several key factors. One significant driver is the increased adoption of digital learning solutions, particularly in higher education and global professional segments. This trend is further fueled by high renewal rates for subscription-based models, multi-year contracts, and the proliferation of digital technology. Additionally, the growing adoption of Inclusive Access Program has contributed to revenue growth, saving students over $1.5 billion since 2018. On the other hand, revenue decline drivers include a decrease in transactional revenue, particularly in K-12 and international segments. Inventory obsolescence reserve is also contributing to revenue decline due to the shift towards digital sales. Higher royalty costs in the higher education segment are partially offsetting revenue growth. The company's revenue growth and decline are influenced by market trends, customer behavior, and product offerings. Seasonality of the academic calendar affects revenue and gross profit in various quarters, with Cone typically being the strongest quarter. Changes in customers' ordering patterns can also impact revenue growth or decline, particularly in segments like higher education. The shift to digital sales is driving changes in revenue mix and impacting revenue growth or decline. The net income of the company underwent a significant change between 2024 and Q3 2025. Initially, it decreased by $32,729 from -$52,928 to -$20,199. However, when looking at the year-to-date (YTD) figures, there was an increase of $14,559 from $71,028 in 2024 to $85,587 in 2025. The profit margins also experienced a change during this period. The gross profit margin increased from 84.2% in 2024 to 85.1% in Q3 2025, while the operating income margin rose from 5.8% in 2024 to 6.9% in Q3 2025. The reasons behind these changes can be attributed to several factors. The increase in net income was largely due to an improvement in operating cash flow and a decrease in credit losses on accounts receivable, as well as a reduction in unrealized loss on interest rate cap. These positive developments contributed to the overall growth of the company's net income. The increase in profit margins can be attributed to improved operating efficiency, which led to higher gross profits. Additionally, reduced expenses and increased revenue also played a significant role in boosting the operating income margin. Overall, these changes indicate a positive trend for the company, with improvements in both net income and profit margins. The company's financial performance is a notable aspect of its overall health. A key indicator of this is operating cash flow, which measures the amount of money generated from core business operations. According to the provided information, the company has been generating positive operating cash flow in 2025. In fact, the data shows that the company's operating cash flow for 2025 was $477,297, a significant figure that indicates a healthy financial position. Furthermore, when compared to the previous year, 2024, which saw an operating cash flow of $687,469, it is clear that the company has maintained its positive cash flow trend. This achievement is a testament to the company's ability to manage its finances effectively and generate revenue from its core operations. The consistent generation of positive operating cash flow suggests that the company is well-positioned for future growth and success. The company's debt level and interest expenses have undergone significant changes over the past year. Initially, it appears that interest expense has increased significantly, with a notable increase of $19,481 from $49,396 to $68,877. However, this trend is contradicted by other statements, which show a decrease in total interest expenses of 29.5% and an overall reduction in interest expense from $173,392 in 2024 to $124,679 in 2025. In terms of debt level, the company's long-term debt has fluctuated over the year. It decreased from $3,164,551 to $2,605,642, but then increased by $42,906 between March and December 2025. Furthermore, a substantial amount of debt was repaid under the A&E term loan facility on July 25, 2025, totaling $385.7 million. Despite these fluctuations, interest expenses as a percentage of total revenue have decreased significantly, from 16.6% in 2024 to 10.9% in 2025, indicating a positive trend for the company's financial health. The financial performance of the company has been mixed across various segments and regions. The higher education segment stood out as a top performer, with revenue growth of $558,099 and an adjusted EBITDA increase of 17.9%. The K-12 digital segment also saw significant revenue growth of $330,746. On the other hand, the print revenue for both K-12 and higher education segments declined by $427,521 and $62,605 respectively. The international segment suffered a revenue decline of -1% and an adjusted EBITDA decrease of minus 38.9%. This poor performance was also reflected in the international region, which saw a revenue decline of minus 6%. The global and professional international segments showed mixed results, with revenue growth but not to the same extent as the top performers. The United States region, however, performed well with revenue growth of $1,490,267. Overall, the company's financial performance highlights areas that require improvement, particularly in the print revenue and international segment. Management is optimistic about the company's future prospects, despite its current operating results not being indicative of future periods. They believe that education has a positive impact on lives and have continuously innovated to help educators unlock learner potential. The demand for personalized content delivered via digital solutions is reshaping the education landscape, creating opportunities for growth. The company's strategy focuses on delivering innovative solutions that meet evolving needs through continuous content updates and subscription-based models. They aim to retain existing customers by upselling and cross-selling, while growing the business through direct sales, online retailers, partnerships with distribution partners, and proprietary e-commerce platforms. Financially, management is confident in the company's ability to generate sufficient operating cash flows to fund its needs for at least the next 12 months. They plan to allocate resources efficiently by optimizing product development, expenditures to maximize long-term return on investment. This disciplined approach will enable the company to achieve growth and stability while maintaining a strong financial foundation. The company's financial strategy has been focused on growth and expansion rather than distributing profits to shareholders. As a result, the company has chosen not to pay dividends to its investors. Additionally, it has also refrained from buying back its own shares, instead opting to reinvest in the business to drive further growth and development. Concerns about inventory buildup and supply chain disruption have been raised due to several factors. One major concern is inventory obsolescence, which has resulted in a decrease in inventories from $51,996 to minus $3,132. This issue is further exacerbated by the fact that the majority of inventories relate to finished goods, making them more susceptible to becoming obsolete. The company's management has attempted to mitigate this risk by setting aside a reserve for inventory obsolescence based on market trends and projected product demand. However, specific dollar amounts have been mentioned in relation to inventory obsolescence, indicating that the issue is not trivial. In fact, a lower inventory obsolescence reserve is noted due to reduced inventory balance. Furthermore, concerns about supply chain disruption are also present. The company's reliance on third-party distributors and the effects of consolidation in distribution and retail channels have been mentioned as potential risks. Additionally, the loss of or reduction in sales from a significant customer could harm the company's business and financial results. These factors highlight the need for careful management and planning to mitigate these risks and ensure the smooth operation of the supply chain. That concludes the financial summary for Mcgraw Hill Inc. Feel free to comment below, and I will be happy to answer them when possible.